For more than a year, I've received a lot of comments regarding the weighted dividend yield of my portfolio, that it is too low and it's better to put my money somewhere else, like a CD, certain ETF, or even a high yield savings account. I'm going to show you why they are wrong by comparing a dividend growth portfolio versus a high yield savings account, since that's one of the most famous tools people use. There's a common misunderstanding of the bigger picture that investors are not seeing. We need to start by defining the concepts. A high yield savings account is essentially a standard savings account on steroids. It functions exactly like a savings account you may have in a traditional brick-and-mortar bank. It pays a significantly higher interest rate, often 10 to 20 times the national average. The core characteristics are very straightforward. The APY. This is the annual percentage the bank will pay you on the money you deposit. It has variable rates. Despite being high yield, the APY is not a log value and can change immediately. The percentage is based on the Federal Reserve and they set it depending on the economic conditions, but is usually higher than a regular savings account. Safety. As long as you use a reputable bank, the money is insured by the FDIC or NCUA, which is $250K per depositor, making the high yield a place to preserve cash. Liquidity. Your money is not locked away. You can usually withdraw at any time, though some banks limits you to 6 withdrawals per month. Now, defining dividend growth investing is a long-term investment strategy focused on buying shares in companies that have a proven track record of increasing their dividend payouts to shareholders year after year. The core characteristics of DGI are the following. Profitability. The company must be consistently profitable. You can't give away cash every year if you're not making any. This means that the company can continue increasing their dividends year after year. That comes with the dividend streak. And then the companies will have a low payout ratio. This is the percentage of earnings a company pays out as dividends. If a company pays out 90% of its profits, it has very little room to raise dividends next year. So the lower, the better. So referring to the comments where viewers stated that the money was better invested in a high yield savings account looks correct when viewing the simple numbers. In 2026, the high yield savings account APY ranges from 3.50% to 4.60%. We're going to use 4% as an average example, while my current weighted dividend yield is currently sitting at 2.40%. For 2025, the average inflation was 2.7%. We're just going to round that to 3% for simplicity purposes. So by doing the simple math, it looks like it's better to have your money into a high yield savings account because your money will be growing 1% per year inflation adjusted, assuming the APY stays at 4%. Meanwhile, for dividend growth investing, it looks like I'm losing money to inflation. But what if I told you that this is not an apple-to-apple comparison? You need to compare the total return versus inflation to see if you're actually beating it, and the dividend yield of a portfolio is not the correct term to use alone. Let me explain. So for a high yield savings account, the APY is the only component generating money, so that is the total return for those type of accounts. For a dividend growth investing is different. The dividend yield is part of the equation. In my case, I do the weighted dividend yield. That is the true dividend yield of an entire investment portfolio. It accounts for the fact that I only likely have different amounts of money invested in different stocks. Now, every company in my portfolio, which I have 21, increases their dividend every year. And for 2025, the average compounded annual growth rate for my dividends was 7%. This means that compared to the 3% inflation, my dividends are growing twice the inflation value. But it does not stop there. The companies in my portfolio that produce those dividends are also established growing businesses, and their stock price also increases. This is called stock price appreciation. This is due to the company increasing their earnings and guidance over time, making the company more valuable. For 2025, the performance return of my portfolio was 12.12%. So when I combine the weighted dividend yield of 2.40% and the performance return of 12.12%, I get a total return of 14.52%. So now returning to the real comparison of total return versus total return, the 4% of a high yield savings account versus the 14.50% of a dividend growth investing portfolio is the correct comparison. And this should answer the question of all those viewers. Even doing inflation adjusted, the dividend growth portfolio stays at the top by miles. Now remember that the high yield savings account rates could go up or down at any time and immediately. For the dividend growth investing side, bear markets could happen at any time as well. Dividends could be cut if the company's earnings decline consistently. But removing both bear case scenarios, the dividend growth investing still beats a high yield savings account. Now, this video is not to bash by any means. Both accounts are important. High-yield savings accounts are used for emergency funds, sinking funds, or any big purchase you're planning to do. For a dividend growth investing portfolio, it is an investment strategy that helps you create wealth, hedge against inflation, and create passive income to cover your living expenses. While investors often pit a high-yield savings account and dividend growth investing against each other as rivals, they are usually allies of a sophisticated financial plan. Using them together solves two biggest problems in investing. One, liquidity, which is having cash now, and compounding, which is having wealth later. So use them accordingly. If you want to follow my investment journey in this channel, I have a playlist of monthly updates where I discuss all my holdings, dividends, performance, and much more. So consider subscribing to follow along. If you learned something new with this video, please give it a thumbs up. Thank you for watching, and I'll see you in the next one.